I'm going to show you the fastest and easiest way to evaluate a mobile home park to determine if it's a good investment or not. The mobile home park valuation formula is so quick and easy that you're going to know if it's right for you or not while you're still on the phone with the seller. The formula has enabled me to buy properties, make huge profits, and minimize risk. As an extra, I'll show you how to value the mobile homes in the park too, so be sure to stick around for that. In the description below, I've included a link to my website, mariodatillo.net, where you can download the seller questionnaire that I've been using for years to evaluate mobile home park investment opportunities on one sheet of paper, and you can go and download that for free. It's the same form that my team has spent since 2015 tweaking, and we use it every single day. You can also use this form if you want to bring a deal to me to partner on. All right, let's jump into this. So valuation is everything, and it can make or break an investment. I'm sure you've heard before that you make money when you buy. So therefore, if you value a property and you overpay for that property, you could potentially lose the property and all of your investment money. There's really two parts to the valuation. One is the cash flow that you earn from the real estate, and the other part is the value of the homes. Now, you can lose a lot of money if you value the cash flow from the home rent. So later on, I'm going to talk about how to value the homes separately. Let's start out with the real estate cash flow because that's what's really important. So you have to understand expense ratios in order to understand valuation. Expense ratios are just basically the amount of expenses that you have to the income that is being generated. For example, if you earn $100,000 in rental income revenue and you have $50,000 worth of expenses, not including the mortgage, that would give you a 50% expense ratio. Now, depending on the property, the size, the utilities, and who's responsible for them, is going to determine what your expense ratio is. It's important to recognize that if the utilities are private, if the utilities are paid for by the park, or it's a smaller park, you're going to have a higher expense ratio, between 45 to 50% expense ratio. If the park is larger or the utilities are all paid by the residents, you're probably going to fall between a 35 and a 45% expense ratio. For the purposes of this discussion today, we're going to use a 40% expense ratio for parks that have all the tenants paying the utilities. Keep in mind too, if the park is only 20 spaces or 30 spaces, you're probably going to be closer to that 50% expense ratio just because the cost of things doesn't necessarily go down because you have less units or less lots in that park. Anything under 30 spaces occupied, you should be figuring about a 50% expense ratio, even if the tenants are responsible for the utilities. If you have a lot of amenities like a pool, a clubhouse, office, anything that costs the park a lot of money, you need to take that into consideration when you're figuring out an expense ratio. For a back of the napkin valuation that we're going to go over today, these are really rules of thumb, and it's going to take going through and evaluating the entire property's financials and modeling it out over multiple years to get true returns and a true value. But you want to know how much the property's worth now, so you know how much time you should be spending with this seller, and that's what this calculation is going to be for. Another thing that you have to understand going into this is a capitalization rate, or cap rate. It's your unlevered return. And easier put, it's your return on investment before your mortgage. Check out the link above for a quick video on how to determine cap rates. Once you have the total number of paying lots, the average lot rent, and who's paying for the utilities, you'll be able to do this calculation. I recommend that you use my seller questionnaire from my website to know all the questions that you need to ask a seller to fully evaluate a deal. All right, let's do this calculation. Take the total number of paying lots, multiply that by your average lot rent, and then multiply that by 12. And that is going to give you your rents for the year, your revenue, right? Then you're going to multiply that by your expense ratio. So if it's a 40% expense ratio, you would multiply it by 0.6. If it's a 50% expense ratio, then you would multiply it by 0.5. Again, if it's a 35% expense ratio, you would multiply it by 0.65. You get the point. That is going to give you your NOI, net operating income. From there, once you've got your net operating income, you're going to divide that by your cap rate, and that will give you the value of the property. As a side note, you're going to want to leave out vacant lots, vacant homes, and also expandable land. Sellers are going to sell you on the upside, the potential to fill all these, but the truth is they don't produce any income right now, so you shouldn't be valuing income that isn't coming in. Now that you have the current value of the property based on this calculation, if you're within range of the seller's asking price, it's probably something that you want to pursue. If you're not, you need to decide, do you want to make an offer even though it's really low? You might. I often do. I'm not afraid to make a lowball offer if I know that it's the true value of the property. If you want to know what the value of the property is going to be after you've already made the improvements and implemented your business plan, meaning added value to it, you're going to be able to use that same exact calculation, but just swap out, let's say, where the rents are going to be. Maybe what the expense ratio is going to be once you bill back utilities, or maybe even what the cap rate will be once you've improved the quality of the property. And that's going to give you your end value, your stabilized value. The difference between the values is the equity that you've created in the deal. Now let's look at the second part of valuing a mobile home park, and that's the homes that come with the park. The truth is that even if a park is mostly tenant-owned homes, it's probably going to come with at least one or two park-owned homes. What you want to do is avoid valuing the homes at all and include them in the value of the park when possible. Often a seller will come to you and say, I really think that these homes have value. I want a price for them. And in that case, we're going to look at it a little bit differently than we looked at the cash flow from the park. You want to value the home based on its shell value, or in other words, what you can sell the home for either as is or after doing the repairs. Regardless, you need to make sure that you don't lose money on these homes, and so be conservative on your sale price. You can look at comparable sales in other parks in the area. You can look at what other homes have sold for in that community specifically. But the most important thing is that you don't value the homes for more than what you think you can sell them for, and you take into consideration all those costs I've mentioned. All right, here's a major reminder, and I'm telling you this because I see a lot of people make this mistake. Do not include the home portion of the rent in the calculation we did at the beginning of this video. If you include that, you're going to be significantly overpaying. And what I mean by that is, let's say a home and lot rent combined are $1,000 a month, but the lot rent in the community or in the market is only $400. You would be valuing $600 worth of rent or income that was actually not being valued by any sophisticated investor, appraiser, or bank. You will seriously overpay for this property if you do that. Let me show you how much money you could potentially lose by making this mistake. Let's use that $1,000 for total rent number that I mentioned before. Let's assume that there's $400 a month applied to the lot rent and that $600 is applied to the home rent. If you take $600 times 12 and multiply that by 0.6, giving you a 40% expense ratio, and then you divide that by 0.08, meaning an 8 cap rate, that would give you a value on that home of $54,000. This home might only be worth $20,000, $10,000, but if you take the difference, that's how much you're losing on every home that you valued and paid for that way. You could lose massive amounts of money by making this mistake. Click like if you think it would suck to lose a lot of money on a deal. It also tells YouTube that this video is helping people, and therefore it pushes it to more people to help, and I'll really appreciate it. Guys, if you're looking to invest in mobile home parks, you should really watch this video that's on the screen. It's about how to finance a mobile home park investment. You can click on it. It'll take you through everything that you need to know about financing mobile home parks.